Good morning. You are watching a live market outlook for Thursday, 9th of February 2012, prepared by Windsor Brokers. Greek problem, of course, remains in focus today as some failures in the negotiations caused the Greek finance minister to urgently travel to Brussels today and try to find some a solution with their European counterparts. The Greek leaders failed today in the extended meeting during the whole night to agree on a reform and austerity program. The price of a financial bailout that will prevent messy default that is hanging above Greece, and this forced the finance minister Evangelos Venizelos to go to country backers, financial backers, with an incomplete deal. He will travel to Brussels later today, where his fellow Eurozone finance ministers had hoped he would present a commitment to make budget savings worth approximately 3.3 billion euros for this year. But after all-night talks with leaders of the three parties in the Greek coalition and with officials from the EU and IMF, Venizelos emerged shortly before the dawn to say that one issue remained unsolved. He said he's leaving for Brussels with the hope that the Eurogroup meeting will be held and a positive decision on the new program will be taken. The financial survival of the countries in the coming years depends on the new program, and it is the time for responsibility for everyone. He did not say what the problem was or why he was not certain the Brussels meeting on the 130 billion euro bailout would go ahead. A spokesman for the Socialist Party said the disagreement over pension reform had been a stumbling block. Also, the heavy protests are still in Athens, as angry people mainly disagree with this austerity plan, and we'll see what will be the outcome for today. Important, need to mention that Euro still holds the positive tone despite quite negative news coming from Athens, as the single currency broke above yesterday's brief consolidation and hit fresh 2 months low high at 133.11, resuming its short-term uptrend and keeping the positive structure still in play. Most likely, as I mentioned in yesterday's presentation, that the markets are still hoping for the positive solution of Greek problem, and as always goes, buying the rumors and selling the facts. So we might see some reversals later on in case of further negative news coming from Greece. Also, today's two important events are the central bank rate decisions from Bank of England and the European Central Bank. All eyes will be on what they will do with the ECB. Is still willing to help Greece when it holds its monthly policy meeting today, with interest rates expected to stay on hold ahead of a major funding operation later this month. The president of European Central Bank, Mario Draghi, might be tight-lipped on the matter. However, with the Greek situation still unresolved, markets will also be looking for hints on whether the ECB is ready to cut rates from 1% to new record lows in the coming months, or if some recent positive economic news has been enough to put the bank on the wait-and-see mode. While it is due to carry out a second ultra-long liquidity operation later this month after a blockbuster 489 billion euros offering in December, the bank is expected to refrain from announcing new measures. One of the officials from ECB hinted yesterday that the central bank could wait, saying bank liquidity concerns had all but disappeared thanks to the ECB's December 3-year loans, adding that he was tempted to declare mission accomplished. Analysts also said that the central bank could relax a bit, as there is very little incentive for the ECB to do anything or say anything. It wants to see how things play out. Comments from Societe Generale, and also the ECB has already done a lot, and they have the next 3-year long-term refinancing operation at the end of the month. Comment from also from Societe Generale. Bank of England is also due to release its rate decision today, and it looks to inject more cash into the economy to shore up a stuttering recovery, despite signs that the country might have avoided slipping back into recession. The Bank of England is today expected to announce 50 billion pounds in additional quantitative easing asset purchases. And though this decision of the 9-member Monetary Policy Committee might not be unanimous, given recent more upbeat economic news, the cash boost would provide welcome news to the government, which has come under pressure again to loosen its austerity drive after the economy shrank at the end of 2011 and unemployment hit its highest level in more than 17 years. The Bank of England surprised markets in October by deciding to restart its program of gilt purchases funded by newly created money earlier than expected. It went on to buy 75 billion pounds worth of gilts, largely to shield Britain from the Eurozone crisis. From the other today's releases, kicking with the UK, again, manufacturing production monthly release is due at 9:30 GMT, and 0.3% is today's consensus, better than the previous month release of minus 0.2%. UK trade balance is forecasted to show a slight narrow in the trade gap to minus 8.5 billion pounds compared to the previous month negative figure at minus 8.6 billion pounds. UK industrial production at the same time expected to show some improvement by 0.2% compared to a negative release of previous month of minus 0.6%. At 12 o'clock GMT official bank rate from UK, and no change expected for today. 0.5% is current rate level is expected to be held, with the MPC rate statement due later after the announcement. Eurozone, European Central Bank, comes 45 minutes after at 12:45 GMT. Also expected to stay pat at 1%. That is current rate level in the Eurozone, with the press conference due at 13:30 GMT, when ECB President will give us some more clues about the further action of the European Central Bank. At 13:30 also, it's the key release from the US, weekly jobless claims that are expected to raise by 369,000 compared to 367,000 of the previous week release. Later in the afternoon at 1500 GMT, wholesale inventories again from US, monthly release 0.4% is today's forecast, compared better than the previous release at 0.1%. Now we're going to take a look at the markets and see the latest, the past 24 hours movements in the market. Starting with the euro, the hourly situation shows that the pair briefly broke above yesterday's consolidation that was limited on the upside by 132.87 and downside by 32.14, one of the previous highs and supports. As we mentioned in our yesterday's analysis, 132 zone was expected to contain dips in order to hold the current positive path of the pair after it broke above its broader past 1 week range of 132.32 and 130.25. The latest rally from 130.25, which is also the range floor of the 30th of January to 6th of February range, has triggered fresh strength that is currently probing levels. This morning it probed levels above 133.00. Positive tone remains. However, the overbought conditions on the short-term studies still see risk of corrective pullback. 132.32 previous high now acting as support, with the overnight lows at 132.14 are offering initial support ahead of 131.90, 132 zone figure support and 20 days moving average that should contain the corrective dips in order to keep the latest rally intact. For now, a loss of 130.25, which is now key near-term support, would delay immediate bulls and allow for a stronger recovery. Otherwise, we see prospect for further extension higher, with the immediate target at 133.21 that market came close to this morning. It's 90 days moving average on the daily chart, and break here to signal a resumption of the broader of the short-term uptrend from 126.22, with Fibonacci level of 50% standing at 134.29, 50% of the down move from 142.46 to 126.22. Seen next interim barrier is 134.00 as a round figure resistance. Break higher is, as I said, to signal for possible extension of the short-term uptrend and possible test of the next significant levels at 134.67.8 of December 2011 highs, and then comes 135 figure resistance and 135.47 lower high of 2nd of December 2011. As mentioned on the downside, the key support remains at 130.25, where is also daily 20 days moving average, and the loss of this level would put aside the short-term bulls in favor of further reversal lower and possible test of the levels towards 129.30, which is next significant support on the downside. The cable lost traction after hitting fresh high yesterday at 159.26, unable to clear a very strong barrier at 159.32, which is 200 days moving average. Also, as mentioned in our yesterday's technical outlook in the morning one, we stated that market might feel some stronger pressure at this level and might struggle to break higher, which exactly happened as a sharp reversal dipped down to 157.90. This is the previous low of 7th of February, 2 days ago, where the latest strong rally started. For now, this level holds the downside. However, further gains need to regain a minimum 158 in order to refocus highs at 158.80, 159 and 159.26. They need to regain 158.80 in order to refocus 159, 159.26. Otherwise, there is a risk of completion of head and shoulders pattern as shown on the hourly chart, with break through 157.90, the neckline, risking further reversal and the possible test of our critical supports at 157.70, previous range ceiling and the strong resistance, and 157.30, the higher low of 6th of February 2012. The dollar-yen holds its positive tone after a reversal yesterday from 77.17, where the pair briefly broke above 55 days moving average, found good support at 77.70. That also marks 20 days moving average on 4-hour chart that for now holds the downside after the pair bounced from a 76 level and attempting to base at this point. Fresh strength again regained the 77 level and the 17 previous high. So far we saw 77.23. It's just ahead of next dynamic resistance of 90 days moving average, currently standing at 77.28, above which to focus Fibonacci level at 77.40. That is 61.8 percent retracement of the latest down leg from 78.27 high of 25th of January down to 76.00, with break here to confirm the short-term base at 76 and attract levels at 77.60 and 78 zone as the next strong barrier. Just to remind you that the pair recently broke above previous strong barrier zone at 78.2030 to briefly actually tested this level where the gains were capped by descending trend line drawn of highs from 2007, where also stands the 200 days moving average that limited the recovery attempt for now. On the downside, 77.00 now acts as initial support ahead of 76.70. Strong support zone, and loss of this would risk test of our key support at 76.50 and would dampen the short-term bullish structure in favor of further weakness and the possible test of 76.00 in the near term. Dollar Swiss is running out of steam as recent recovery attempt and failure to clear the key near-term resistance at 92.50 also range ceiling. Brief break here, managed to break for a few ticks. Only 92.61 was seen ahead of sharp pullback. Today's break below 91 static support, 91.13 previous range floor and 91 static support, where the prices dipped to 90.89 so far, risks an extension of the broader downtrend from 96 zone, and initially to test 50% retracement at 90.75 and possible extension down towards 90.00 figure support ahead of Fibonacci level at 89.55, which is 61.8% of 85.66 to 96.00 level, 96.00 high, to resume the current corrective pullback of longer-term uptrend from 70.67 9th of August, all-time low of dollar Swiss. On the upside, 92.50-60 zone is for now expected to cap the upside and only break above this level to significantly improve, 92.50-60 is expected to significantly improve the current negative structure of dollar Swiss. The gold is still at the back foot after yesterday's after a bounce from 1710, where the temporary base was found, failed to regain previous height 1763 as the gain stalled at 1752 zone, and followed by subsequent reversal down to 1724. The current rally seems to be running out of steam. We need to see a regain of minimum 1752 in order to reattract the levels at 1763 previous high and resume the recent recovery. However, wider picture studies are still in the positive tone, but recent loss of momentum still risks further reversals despite the positive structure and 20 days moving average breaking above all three larger ones and supporting currently the uptrend from 1522 low of 28th of December. Critical support for now on the near term is 1710, 1700, loss of which might signal further delay in the recent rally and open way for a stronger reversal to the downside with the 200 days moving average at 1655 seen as a key level. This is also approximately 50% retracement of the move from 1562 to 1763, and the loss of this one would signal a return back to the weakness, a broader weakness of 1920 record high of gold. Ability to regain 1763 and 1800 is would signal strength. Is the pair is the gold is back to strength, and possibly to refocus 1900 and 1920. The crude oil remains, a broader picture remains in the downtrend of a recent high at 103.72 posted on 5th of January, as series of lower tops define the channel lower, with the lowest price seen at 95.43 posted on 2nd of February, where the 90 days moving average contained the dips for now. Recovery attempt from this level 95.43 has so far reached 100.05, and the oil is currently struggling to hold around this level, as strong pullback on yesterday's crude oil inventories dipped down to 98 zone, previous strong resistance now acting as support, with some positive structure still seen on the near-term studies. Clear break above 100 is required to resume the near-term recovery, with the main bear trend line currently standing at 185, ahead of our next strong barriers at 101.2030 zone, above which is to signal stronger recovery and break above the short-term downtrend from 103.72. Failure to clear 100 and 185, the trend line, would signal further extension to the downside, with initial supports at 98 zone, and then 95.83, and the key near-term support at 95.43, loss of which to possibly attract our next very strong support, and 38.2 Fibonacci retracement of the broader uptrend from 74.94 at 92.70. Good luck.